Hello, this is Soji, and you are welcome to Soji Forex. A big shout out to all our new subscribers. Thank you for subscribing to our channel. What we do on this channel is basically we try out trading strategies and method. And after discovering how profitable those strategies are, we come to share with us on this channel so we can take advantage of it and apply them in order to make profit from the financial market. So in this video and in the subsequent video to come, we'll be looking at liquidity and motivation and mitigation strategy. Liquidity and mitigation strategy. Please, if this is your first time of coming across this channel, I'd like you to like the videos, subscribe to our channel, and turn on your notification bell so that you'll be the first to get notified whenever we publish our next video. So today we are looking at liquidity and mitigation theory, but let's focus on liquidity in this video. Now, what is liquidity? Liquidity is money. Liquidity is money. Liquidity is stop loss. Okay? When we talk of liquidity in the market is money. The area of liquidity is where money lies in the market. And why do we say so? Because the market needs money to move, and the money needed for the market to move most of the time is in the area where there are stop loss. So what the market maker does, the big boys who control the market, what they do is that they move the market in the area of where the monies are. And once that is done, they take away our money and then move the market in the direction of their choice. So what I'm trying to say in essence is that before the market, for instance, if they want to move the market in a buy direction, if the market makers want to buy, which is to go up, the first thing they will do is that they will sell. So they will sell down and then move up. Meanwhile, the original intention is for them to buy, but they begin their buying by selling, and after selling down, they now move up. And this is what brings about the concept of our higher high and higher low, because they always go down to sell. And why are they going down? Because they have identified that there are some money lying down in the downside. Okay, let's take for example, let's say for instance, okay, let's say for instance, the market is ranging and you'll be seeing price going up, hitting a particular level, support, resistance, support, resistance, support, resistance. Now this is our resistance zone, this is our support zone. What is the implication of this? If you trade price action you know that once price gets to this support level, you will buy from here, and then your stop loss is below this point. And if you are to sell, you will sell from here, and you have your stop loss above the resistance level, right? And what does that mean? This stop loss you are putting here, the stop loss simply means money. You are saying that if this market go against me, I am willing to lose this particular amount of money. So every area of stop loss is the area of money. So liquidity is stop loss. Liquidity is money. So what this guy does is that they will come first and clear liquidity. They will take your money, take you out of the market, and then come down as if they want to sell. If possible, they move in the original direction. They will go up, come down here, remove these people here as if it's a sell, break this stop loss, remove the people that are down here, and then move up again and remove these people, and then continue in their direction of making higher high, lower low, higher high. So, and in the same way, it's equivalent to a sell. You will sell, you will think, okay, they want to buy, they want to sell, So the first thing they will do is they will buy. They'll come up here because they know there is a stop loss up here. They can push in, remove the stop loss, and then continue to the downside. You can agree with me that most of the time, market goes in your direction after taking you out of the market. It will eventually, then you are wondering, it's not as if your analysis was bad, but how come the market took you out and then went in your direction? What happened is a typical example of what we call liquidity sweep. So they'll first of all remove the impatient traders out of the market. So Forex is about taking money from the impatient trader to pay the patient trader. So since you and I don't have the equivalent capital to move the market in a direction, it has been proven over time by people who were privileged to have traded for some of those hedge fund companies that there is this pattern they trade, and if we know this pattern, we can trade with them. Since these people, they are smart and they play us a smart techniques, if we know their smartness, what they do, we can as well follow their footsteps. And so what it means is that as a smart money trader, you identify the area of liquidity, you wait for the liquidity to be taken, then you follow them in the direction of the liquidity. Then you follow in the direction of the liquidity. Okay? So that is for that. So let's continue. Now we have two major types of liquidity. We have two major types of liquidity. We have internal liquidity, or let me say, we have static liquidity. we have static liquidity, we have dynamic liquidity. Okay, two major type of liquidity. One, we have the static liquidity. Two, we have the dynamic liquidity. So when we talk about static liquidity, what are we referring to? We are referring to a liquidity that is more or less like in a particular location. For example, in a ranging market, you see market doing higher high, up, high, low, high, low, high, low. So this is a typical example of a static liquidity, because this is the liquidity zone in this market. This is money here. So this is a static liquidity. Okay. Then we have another one as a dynamic liquidity. So the dynamic liquidity is common in an uptrend or a downtrend. That is where the market doing higher high, lower low, higher high, lower low, higher high, lower low. Now this is a dynamic liquidity, because all this zone is area of liquidity. Why? Because there are stop loss. If you are to sell from here, you have your stop loss here up, and if you are to buy, you have your stop loss, like for those that do trade trend line. So all this zone where you put your stop losses are areas of possible liquidity, and that is dynamic liquidity. So dynamic liquidity are liquidities that are not at a fixed point. For example, if you look at this our chart by drawing this trend line, okay, you agree with me, this is one high, lower high, lower high, right? This is a lower low, lower low, lower low. So all these zones are areas. This is dynamic liquidity. Dynamic liquidity. And then let me show you something interesting that happens here. Looking at this is our lower high, right? Lower high, lower low, lower low, lower low. Now if you are a trend line trader, you will draw your trend line this way, and then once market get to this point, you will sell, and your stop loss is above that high, right? You will take your profit when it comes to this downtrend line. You've succeeded in that case. Then the market pull back to this region, right? And again you sell, you take your profit, you are safe, and your stop loss is here. Then look at another thing that happens, and again the market was coming down, and then you eventually sell from here again, because this is your area of the trend line. You sell from this point, okay? You sell from this point. Now look at what happened. Okay, with your trend line and your trend line. Alright, now you sell from here, because this one was successful, this one was successful, and then when you sell, you look at it like there is a bearish candle inside of this place. which is like more or less trying to form something like an evening star. You said, okay, based on my candlestick strategy, candlestick pattern, this is a reversal signal. You sold. Now look at what happened. The market went up, breaking this trend line to the downside. And remember, your stop loss can never be above this high. And then see what the market do. It break out, take you out of the market, and then return and still sell in your direction. Now what has happened at this point is a liquidity sweep. Liquidity was taken. Your stop loss that was at the top of that high was taken. And what type of liquidity is this? It is not a fixed level. This is a different level. This is a different level. So it's what we refer to as dynamic liquidity. So dynamic liquidity was taken at that point. Dynamic liquidity, because you sold here and then the market went up, took you out from your stop loss here. So this is a dynamic liquidity, and that is what we are trying to explain. Okay? Dynamic liquidity. Now let's look at example of a static liquidity. Okay, we need where the market is eventually ranging. Okay, need to see where market is ranging. Let's go to 1 hour. Good. Now, looking at our chart here, you will see that this market has been ranging over time. Okay, you see that this is a support, this is a resistance. You see this level, support and resistance, and you see that market has been going up, coming down, going up, coming down. So this is their stop loss. Inside of here, people have bought, people have sold. Okay, but the original move of this market, good. Now you can see what happened on this level of resistance that has been here. These guys want to sell, but look at what they did. They moved the market up, taking away the people who sold. Okay, after they break the resistance up, taking away the people who sell. And I know even you in your mind, you are saying, oh, they have break the resistance. Now we are going up. The market has given us direction. And then you dive in that, oh, we are going up now. The market is leaving me. Let's enter. You place a trade that you want to buy. Eventually, the market moves up. And then the next thing, it got to this level, before you know, it reverses back. And take even you that joined the buy, the market, take you out. And how do we know? You can see the explosive move of this particular green bullish candle to show you that it is the big boys, the market makers, that are pushing the market. You can see how massive this green candle inside of here that took away all this liquidity in the upside, you can see how massive the candle is. Okay, so eventually they take you out. The people that are selling, they took them out. You now say, the market is leaving us. They have given us direction. Okay, it has break out. Okay, according to the strategy, when it break out, it will retest and then it will begin to go up. And then when it retests and give you this bullish play of this candle inside, and I say, we are now going up, we are now going up, you now bought. Do you get? And then you are the one that trade, okay, moving average as well. You say, oh, I can see there is a hammer inside of this place. Okay, let's go now. You bought, and then the next thing, the market keep going down. And when it comes down toward this area again, you now say, it's now at the support. It's at the support, it will go up, and then you can see how the market keeps on going down and down and down. So this is simply about dynamic and static liquidity. Now the concept of liquidity is very important, and in the dynamic liquidity we still have two types. We have internal dynamic liquidity and external dynamic liquidity. While for the static, we have internal static liquidity and external static liquidity. So this video is part 1. I don't intend this video to be long. This is part 1. We have tried to explain what liquidity is all about. We've tried to explain the major two types, the statics and the dynamic liquidity. So in the subsequent video, we'll go further to explain static internal liquidity, static external liquidity, and as well as we will now explain dynamic internal liquidity and dynamic external liquidity. When we have everything about smart money trading is liquidity. If you can understand liquidity, you are good to go. The remaining parts are applications. It's for you to know your premium and discount zone, know how to use your Fibonacci, your order block, your fair value gap. Then you wait for the market to come to those regions. Combine with your knowledge of structure, which we already have some of those videos on this channel already. So let's focus on liquidity for this season. Having established and being grounded, then we take the journey forward. I believe you are getting value from this video. Please do not forget to like, to subscribe to our channel, share this video with your friends and with your loved ones. So in the subsequent video, we shall be dealing with the types of internal liquidity and external liquidity. Until then, do well to go through the video again and see you in the subsequent video.